Today, we're diving into one of corporate finance's most powerful and, yeah, most controversial tools, the share buyback. So, is it a smart way to reward shareholders, or is it kind of just a trick to juice the stock price and executive pay? Let's dig in and find out.
To really get a sense of the scale we're talking about, just look at this number, $1 trillion. That's how much corporations authorized for buybacks right after the 2017 tax cuts. This isn't some niche financial strategy. It is a massive, massive force shaping our economy.
All right, so let's break this all down. First up, what exactly is a share buyback, and how in the world did this become a go-to trillion-dollar tool for pretty much every big company out there? You know, at its core, a share buyback is actually pretty simple. A company takes its cash, goes onto the open market, and buys its own stock. You can think of it like a company investing in itself. And when those shares are bought up and taken out of circulation, the whole ownership pie is now split among fewer people, which makes each remaining slice just a little bit bigger. But here's the thing, it wasn't always this common. For decades, buybacks were super rare because companies were afraid they'd be accused of manipulating their own stock price. That all changed back in 1982. The SEC created something called Rule 10b-18, which was basically a safe harbor protecting companies from those charges. And as you can see, that one little rule change just opened the floodgates, leading to this explosive growth, all the way up to that trillion-dollar figure in 2018. Okay, now this is where things get really interesting. It's how this simple transaction can completely change a company's financial report card. It leads to something that some analysts call the EPS illusion. It really is all about the math. So imagine a company's profit is a pizza, right? Before the buyback, you've got 10 million shares, or slices. With $100 million in profit, your earnings per share, or EPS, is $10. Simple enough. But after the company buys back 10% of its shares, you still have the exact same pizza, the same profit. But now it's only cut into 9 million slices. And boom, just like that, each share is now worth more, with an EPS of $11.11. And this is the absolute key point here. The business itself didn't get any better. Sales didn't go up, no cool new products were launched. That EPS growth is purely, and I mean purely, the result of financial math, not any real economic growth.
So you might be asking yourself, if it's just financial engineering, why are buybacks so incredibly popular? Well, a lot of research points to a very powerful and, let's say, very personal incentive.
This quote from a really important academic study gets right to the heart of the matter. See, researchers found this direct, undeniable link between the rise of share buybacks and the way top executives get paid. And this table here just lays it all out. The study's main findings? Well, when a CEO's bonus is tied to that same EPS number we just talked about, their company is way more likely to do buybacks, and bigger ones too. And look at that last point, the timing. These buybacks are especially likely when the company's EPS is just below the finish line for a big bonus. Funny how that works, right? And get this, it gets even more personal. Research from an SEC commissioner found that, on average, corporate execs sell 5 times more of their own stock in the week right after a buyback announcement, which, surprise, surprise, is a time when the stock price often gets a nice little bump. So this leads us to a massive question. I mean, every single dollar a company spends buying back its stock is a dollar that it can't spend on something else. So what's the opportunity cost of this whole trillion-dollar trend? It all comes down to a fundamental trade-off. It's a choice. On one hand, you can give that cash back to shareholders. On the other hand, you could reinvest that cash into the company's actual future. You know, funding the R&D that creates the next breakthrough product, raising wages for your employees, or upgrading your factories. It's a choice between a short-term payout and a long-term investment. And this isn't just some abstract idea. Just look at the pharmaceutical industry after those 2017 tax cuts. 10 of the biggest drug companies spent nearly $75 billion on buybacks, while they spent less than $72 billion on the R&D that actually leads to new medicines. The numbers are just staggering when you look at other industries, too. I mean, the money Walmart spent on buybacks could have given 1 million of its workers a raise of more than $5.50 an hour. At other big retailers, that same money could have meant an extra $18,000 for every single employee. It really puts the scale of these financial decisions into perspective. Okay, so how should an analyst or an investor or even just a curious person think about all this? It really comes down to being able to tell the difference between real, organic growth and simple financial engineering.
You see, there are two paths to making each share more valuable. The first is real economic growth. You innovate, you build new things, you expand, you actually generate more profit. The second is financial engineering. You just shrink the number of shares to make the math look better. One path grows the entire pie, the other one just reslices it.
So, the next time you see a company announce a big buyback program, here's a quick little mental checklist for you. Is the whole business growing, or is it just the EPS? Are they buying stock when it's cheap, or are they overpaying? And maybe most importantly, what are they giving up to make this happen?
And really, at the end of the day, it all comes down to this one simple question. Is this action designed to grow the actual company for the long term, or is it just meant to boost the stock price in the short term? The answer to that question tells you pretty much everything you need to know.
So, share buybacks are clearly a complex tool, with potential benefits, for sure, but also some really significant drawbacks. As we've seen, it's a story about incentives, opportunity costs, and that fundamental question of what it really means to create value. This is not financial advice.